Good morning, good afternoon, good evening. I'm Nicolas Veron. It's my pleasure on behalf of the Peterson Institute for International Economics to introduce this new session of the financial statement series on liquidity risk and systemic risk. And we will have a presentation. We're very honored to have a presentation from Rajan, very highly distinguished academic and public servant. He studied initially at the Indian Institute of Technology in Delhi, then got an MBA from the Indian Institute of Management in Ahmedabad in 1987. Went on to MIT, the Massachusetts Institute of Technology, for a PhD with a thesis titled Essays in Banking. So very much about the structure of financial systems and completely aligned with this series. So we couldn't think of a better speaker. And then in 1991, he became faculty at the Chicago Booth School of Business, where he's been ever since, over 30 years, but with multiple other ventures, visiting professorships, of course, but a highly distinguished career in policy. From 2003 to 2006, the chief economist and director of research at the International Monetary Fund in Washington, the youngest ever chief economist at the IMF, I think, and the first ever from an emerging market country. Then in 2007, he was the chair of a group that produced a report for the government of India on structural reform of the financial system, titled 100 Small Steps, one of the best recommendations of structural financial reforms I've ever come across. Then in 2012, he became the chief economic advisor to the finance minister of India, preparing the economic survey of India in 2013. And in 2013, of course, he became the governor of the Reserve Bank of India as a central bank for a 3-year term until 2016. I won't have the time to mention all the awards and publications of Raghu. I'll mention one which had a seminal influence on me, which was part of his long-standing work with Luigi Zingales. In 2004, he published Saving Capitalism from the Capitalists. And the title, I think, is a whole program of how to think about structural reform, particularly in the financial sector. Megan Greene studied at Princeton and got a bachelor's degree in political economy in 2001. Then she also graduated from Oxford in 2006. She had a very versatile career. She worked at JP Morgan Chase and was an advisor to the Liechtenstein ruling family on financial matters. Then she taught early European history and German at the Phillips Academy in Andover, Massachusetts, which was a perfect preparation for being a leading analyst and very prominent analyst of the European crisis, starting in 2007 at the Economic Intelligence Unit, then at Rubini Global Economics and a firm, Maverick Intelligence, which she co-founded. And then from 2014 at John Hancock Financial Services and Manulife Asset Management, where she stayed until 2019. Since then, she's been at the Harvard Kennedy School as a senior fellow at the Mossovar Rahmani Center for Business and Government. She's also been, since September 2021, a global chief economist at Kroll Consulting, the risk advisory firm. And she now teaches at Brown University, at Tsinghua in Beijing, at the European University Institute in Florence, and also, as I think everybody here knows, is a regular columnist in the Financial Times. I don't know how you do all these things together, Megan, but with that, I will hand it over to you, Rag.
Great. Let me share my screen. Thank you very much for having me. It's a great pleasure being here. Let me see, share screen. Okay, do you guys see the screen? Great. So this is work with Viral Acharya, Rahul Chauhan, and Sasha Stephens. And basically what we're trying to do is figure out, we've had an unprecedented expansion of central bank balance sheets. And really what that means is central banks have put out the most liquid asset on the planet, which is central bank reserves, in large quantities into the financial system. And yet, we've had surprisingly fragile liquidity conditions in money markets. Pre-pandemic, we had the repo rates spike in September 2019. We had the dash for cash as the pandemic started hitting in March 2020. We had the turmoil in UK gilts in September, October 2022. And when you talk to market participants, they complain about the state of liquidity in markets. Of course, different people mean different things. But it seems as if even though central bank balance sheets are pretty big still, even the small adjustment downwards with quantitative tightening is tightening conditions quite a bit. So the question is why? Why is it that we've become so dependent on liquidity? Where did all the liquidity that was infused go? And our point, very quickly, is that the commercial banking system, as well as the financial sector, doesn't stay still when the central banks pump the markets full of liquidity. There is a buildup in commercial bank liabilities, which are very demanding of liquidity, liabilities like wholesale demand deposits. But also you see an expansion in claims that in claims that commercial banks write on liquidity, such as lines of credit, which basically offer corporations liquidity on demand. So when you aggregate all the claims on liquidity written by commercial banks, as well as other financial sector firms, there's not a lot of spare liquidity around. And when the central bank tightens liquidity supply through means like quantitative tightening, it turns out that this tightens the system very quickly. That's the point we want to make, largely in the context of the previous episode of liquidity tightening, quantitative tightening, which happened between 2017 and 2019. So that's what I'm going to show you in just a bit. Very quickly, just to fix ideas, there are two ways that that central banks can expand their balance sheets, and therefore two symmetric ways in which they can contract. One way they can expand their balance sheet, just look at the banking sector in the bottom right corner, is the central bank can essentially buy treasury securities from bank balance sheets and supply them reserves instead. That's a direct swap with the banking sector, doesn't affect any liabilities of the banking sector. A second way central banks can expand their balance sheet is by buying from the non-bank sector, buying treasury securities from the non-bank sector. And effectively, after all is said and done, what happens is the non-bank sector deposits whatever proceeds it gets with the banks. And so again, go to the bottom right. When you look at the banks, what you have is the banks now have additional reserves on the on the central bank, but have financed it with deposit claims which they have issued to the non-bank system. So there's a expansion in commercial bank balance sheets at the same time as central bank balance sheets are expanding, in this case, financed with demand deposits. So if you look at the commercial bank system, it doesn't have any spare liquidity at this point in one sense, which is it has reserves on the asset side, but they're offset by demandable claims is issued on the liability side. So the question really is, when the central bank expands its balance sheet, what do we actually see in terms of what the commercial bank does? And what I want to show you is what happens. So here are the reserves of the Federal Reserve over time. And what you see is during the three phases of QE, QE1, QE2, and QE3, they typically go up. And then there's a post-QE phase between 2014 and 2017 when, nothing really explicitly happened, but what happened was that reserves came down gently. And then QT started in 2018. Reserves came down quite sharply until the events of September 2019, when the Federal Reserve said, hey, there are too few reserves in the system, and it started pumping them back in. That's the inflection point you see on the right-hand side of the scale. And then when COVID hit, there was a massive expansion in the Fed balance sheet. Now, what about the demand deposits. And what you see is over this period, demand deposits have been going up. Deposits have been going up steadily. I'll break them up into demand and time in just a second. And if you look at lines of credit issued by commercial banks, they also went up steadily, again, with sharp blips up. For example, in March 2020, when after a period of drawing down reserves, commercial banks wrote a lot of credit lines to the non-bank sector. Now, these credit lines are undrawn credit lines, and the blips you see sometimes are because there's been a drawing of those credit lines. We can come back to the details in a little. But the point I want to make is really this. When you look at the ratio of these liabilities, credit lines, deposits, these are claims on liquidity. You look at those ratios relative to reserves, what you find is during the periods of QE, they come down. So in a sense, the ultimate backing for these, which are reserves, it suggests during the period of QE, there's plenty of liquidity relative to the claims. But as soon as you start moving into the post-QE world, and of course, as you start tightening, the claims relative to the reserves go up dramatically. In other words, the backing for these claims falls. Think about a dash for cash. That's a dash for reserves. And essentially, that becomes more likely because there are so many more claims outstanding on liquidity relative to the availability of liquidity. And of course, after the Federal Reserve comes back into the markets in September 2019 and pumps the markets full of reserves again, you see this ratio fall. What is interesting is within deposits, you find that demand deposits, that's the green line here, are going up all the time. It's not just deposits, but demandable claims are going up. But time deposits are coming down. In other words, it's the claims are becoming much more demandable on the banking system. It's not just banks are financing reserves with deposits, they're financing them with demandable deposits. In fact, it gets a little more precarious because it's not just demandable deposits, it's uninsured demandable deposits. And this is the last point I want to make here. If you look at uninsured demand deposits, that is the dashed blue line, you see that is also going up tremendously with reserves. So the bottom line of all this is the claims on reserves are going up tremendously. When we look within banks, you find exactly the same thing. Banks that accumulate more reserves over this period are issuing more demandable claims, shrinking time deposits, and they do it in both in terms of the quantities, but also in the prices they pay. Banks that have a lot of reserves are paying far less for time deposits, in a sense, almost driving them away. And that's suggestive that, in fact, they're increasing their dependence on liquidity because they're issuing more demandable claims relative to the reserves. What happens during QT is this doesn't reverse for the banks themselves. They have a lot of claims outstanding, but they don't, and they have fewer reserves, but they don't shrink their claims. And that makes the system much tighter and much less able to withstand shocks like the shocks that happened in September 2019. One last point before I hand it over to Megan, is it that, when the central bank starts quantitative tightening, these commercial banks are replacing the reserves they give up with eligible assets, therefore repoable assets like treasuries, etc. Is that a problem? Is that what's going on? And it turns out that's not what's going on. Because if you look at the demandable claims that commercial banks have issued, credit lines and demandable deposits, you find that when you look at the ratio of those claims relative to reserves and eligible assets, that also is going up. In other words, there is, again, a problem of too many demandable claims relative to assets that can satisfy them, whether they're reserves or eligible assets. The problem, however, is when commercial banks build up eligible assets without having adequate reserves, this means that they're reliant on borrowing reserves in the interbank market when they find that they're experiencing tightness. But of course, if everyone relies on borrowing reserves at the same time, there may not be enough reserves. That's the dash for cash phenomenon when the central bank has to come in once again. Last point, and then I'll hand it over, which is, why does this matter? Can't the central bank keep coming in and dumping reserves into the market as the market wants? And the reality is, if you think there's no cost to the central bank expanding its balance sheet whenever there is a need, then there's no problem. However, the reality is there are a number of things that are going on. One, as the central bank expands its balance sheet, the commercial banking system writes more and more claims on liquidity, which then makes it very hard for the central bank to contract its balance sheet, certainly back to the old level. So you have permanently expanded levels of the central bank balance sheet. Is that a good thing? Well, it depends on what it's used for, and depends on what kinds of signals it sends for the longer term monetary policy stance, for the how much it facilitates longer term fiscal expansion. Those are issues which we can come to in the discussion. But the reality is central banks are supposed to intervene briefly in order to alleviate situations of liquidity stress. What we're saying is, with the commercial bank response, with the associated non-bank financial system response, this means that we are continually seeing a ratchet effect. Central banks have to keep a larger and larger balance sheet to satisfy the liquidity needs of the system, and that has potentially longer-term consequences that we have to think of. Let me stop there and hand
Just
it
before
back.
before you share your screen, we have a question about the sample of banks in this slide. Can you briefly answer that one?
Sample of banks. These are all U.S. banks, U.S. domestic banks, not the foreign banks. However, if you look at the foreign banks, they don't do much in the form of deposits, but they're borrowing in the interbank market and lending. They're borrowing and lending reserves, something that one of our colleagues, Wenshin, has looked at. But if you want details, I'll send you our paper that has a section on the foreign banks. Okay, let me unshare.
Yeah, great. Thanks so much, Raghu. I was actually in Jackson Hole when your co-author presented a version of this paper, at least, and I found it to be one of the more interesting papers at Jackson Hole. For me, there were kind of three main take-homes. One is that QE doesn't work the way we thought it did, which it baffles me. We're still figuring out exactly what channels are effective for QE, and there are very different attitudes towards that in academia versus financial services, I can tell you that much. But what you noticed was that maturities actually shortened off the back of QE. We had expected them to lengthen. So there are big questions about how QE even works that still need to be answered. Secondly, QT is not like watching paint dry, as Janet Yellen had really hoped it would be. And thirdly, big central bank balance sheets are Hotel California. We really can't get out of them. And every time we run into a blow up as a result of it, the only solution is for central banks to step in and paper over these market dislocations, as the Bank of England did last fall, for example. But what you're arguing is that just makes the problem worse, and so suggests that as we try to shrink balance sheets, we are going to continue to have these blowups more and more often. So volatility should be structurally increased as well. The question you finished with, Raghu, was a question I wanted to start with, was, well, then why do QT at all? And I think that there are compelling political reasons for why central banks need to reduce their balance sheets, mainly that they're worried about their independence. They don't want to be under the thumb of the Treasury, for example, in the US. But I'm not sure there are as robust economic or financial arguments for why central banks have to shrink their balance sheets. If they end up taking losses, after all, they're not regular banks, that's fine. I don't think that needs to be a big deal. You end up having a risk of permanent fiscal financing by the central bank. But some would argue that that's actually a solution to the debt-driven growth model that many developed markets have come up with. So if that is our growth model, is this not a solution? Why do QT at all? In 2019, when I was chief economist in asset management, I had an interesting conversation with Janet Yellen at the time because liquidity was pretty ample, it seemed, but my traders were complaining constantly that they couldn't get big trades through. So they were arguing that actually liquidity was really thin. And we're really frustrated with it. And so I asked Janet Yellen about this, and she said, yes, Megan, that's a feature, not a bug. We don't mind that you can't get big trades through. That actually might be a feature of financial stability. So I wonder to what degree, obviously the Fed doesn't like the repo spike that we saw in October 2019, and it doesn't like the dash for cash. It doesn't like having to step in. But I wonder if there is some degree to which central banks and the Fed in particular are okay actually with thinner liquidity because it reduces financial stability risks. So that's another question I have for you. I have a series of questions for you, Raghu. Thirdly, it seems like off the back of the repo spike, a standing repo facility was set up. And in my conversations with the markets folks at the New York Fed, it seems like they figure that's the release valve, and that will be all right. Anytime there is a repo rate spike, then the standing repo facility can sort it out. I wonder how true that is given counterparty eligibility. And I know that there are, again, political reasons why the Fed might not want to extend the standing repo facility to non-banks. But economically or financially, I wonder if that's wise. In my view, I think it's probably not big enough. There aren't enough counterparties eligible for it. And so it should be expanded and broadened. I also wonder, your work looked at 2019 and also the dash for cash, but banks are much better capitalized now than they were in 2019 even. So I wonder if banks being better capitalized might mitigate some of these issues. And then you mentioned looking at foreign bank organizations, and I know that was the respondents' line of argument at Jackson Hole when your co-author presented this paper. But I do wonder if maybe in addition to the liquidity problems reflecting mismatches on bank balance sheets, it's also just reflecting constraints of bank balance sheets so that they're unable to intermediate when there are liquidity issues. And along those lines, I wonder if we can get rid of some of those constraints without negative implications, particularly looking at the supplementary leverage ratio, which seems to limit banks' ability to hold reserves. It seems to me it's under discussion. There's no real urgency, but if we are going to have these liquidity blowups, I wonder if banks shouldn't be allowed to hold reserves as risk-free assets, because that's how they view it. That's how most of us view reserves, if that isn't a valid argument. I'll finish my comments there.
Fantastic. Fantastic set of questions. So Raghu, you have to answer that.
Sure. Look, I thought Megan did a wonderful job summarizing the three main points. QE doesn't work the way we thought. In part, the whole idea was that you take away duration from the market, and the market would reestablish duration, perhaps through the real sector. You'd finance a whole lot of long duration projects. And what we're sort of saying is, look, even the financial sector is offsetting this simply by shrinking the maturity of their liabilities. So the banks themselves can't finance longer term projects because they're so much more dependent on short-term liabilities. So that offset is something I don't think people have paid a lot of attention to, including the rise in claims on liquidity. Second, absolutely, QT is not like watching paint dry, because lots of things happening in the financial sector, which are not simply a reversal of QE. In fact, one of the problems is the liabilities don't shrink in the same way as they built up. And thirdly, Hotel California, check out anytime you like, but you can never leave here. And that's the problem. You keep getting expanded balance sheets. So what's the cost? Well, coming from an emerging market, which spent many years trying to get away from central bank financing of government of the government fiscal, I know that the longer term consequences of that kind of dependence are terrible. And what we're drifting into is implicitly, while keeping the market liquid, we're also effectively providing a free tap for the fiscal system. And yeah, the modern monetary theorists wouldn't worry a lot about it, but I think that theory is a little under the weather right now. I do think going back to fiscal financing is really problematic. The other thing which we pay much less attention to is you're distorting the price of liquidity. And the question is, does this change allocations in the market? And I haven't put my finger on this, but this is something I worry a lot about. Is the fact that banks are willing to take much more financial risk as opposed to willing to take real risk. We would want them to take real risk, finance a lot more projects, finance a lot more real activity. But we've seen a lot more financial risk taking in the system. Has that something to do with the plentiful availability of liquidity? I pose that as a question. I don't know the answer, but I do think the distorted price of liquidity when central banks come in a big way, but also assure you that they'll keep coming back whenever you need it, then creates the kind of structures that perhaps may distort real activity.
Can I ask you something along those lines, Raghu? If you're distorting the price of liquidity, then can you figure out how much liquidity there is, or are you just in a soup of liquidity where there's constantly ample liquidity, and if there isn't, the central bank will step in?
Yeah, it's one of those things, right? There's too little when it blows up, but you don't know what's enough. I mean, what I have in mind is the Federal Reserve in 2019, around the time you were talking about, came out with a paper which has this title. What do you do? I mean, I don't remember the precise title, but how do you operate in an environment of ample reserves? So basically saying there's plenty. And this was just before the September 2019 blow up, which caused them to go back in. And that's suggesting we don't fully understand, how much liquidity is enough. And that, to my mind, is part of the problem, that we'll know it only when it blows up. And part of the reason is we're not paying attention to all the ways liquidity is being consumed by the market through these kinds of liability issuances. I think the standing repo facility is obviously a change since the September 2019 blow up, but we don't know how it works. I mean, clearly there is some stigma with going directly to existing facilities at the central bank. But does the standing repo facility, which is relatively unused in normal times, will that suffer from stigma or not? And then the point you made, which is there are only a small number of eligible counterparties, and it's not that widely available. So even if there is a dash for cash, you need the people who have access to the standing repo reintermediate everywhere else. And the problem at those times is those guys hoard. There's a lot of hoarding of liquidity by those who have access. I've heard a CEO of a money center bank basically say, we're not going to step in next time there's a liquidity problem because, one, we don't know how much liquidity we're supposed to have. And two, when we do step in, we get a lot of grief, sometimes for quote unquote not doing the right thing. So we're going to wait and see what happens. Banks are obviously better capitalized, so liquidity doesn't turn into solvency problems as fast. And I think this is good news. But the question is, who has the solvency problems? And what we've seen is that when liquidity dries up, something goes bust in the system. Now, may not be directly as a function of liquidity, but there are too many quasi banks with demandable claims, runnable claims that emerge. FTX was one, but there were others. We had the stable coins which were run. What else is there that is runnable? We'll figure out. I mean, effectively, we saw the pension funds in the UK had a problem again with liquidity. I mean, the real problem was they couldn't get access to funding to back up the margin calls that were made on them, and so it was a liquidity problem. So let me stop there. These are all very important questions, and I don't have perfect answers to them, but I do think it's worth looking at what's going on in the markets.
This is fantastic. We have very distinguished participants in the audience. Some of them have already started to engage. I usually do the acronym police here, but I was hesitant about QE and QT. Of course, that's quantitative easing and quantitative tightening, but that's replacing acronyms with jargon. So I guess the audience is familiar with all these semantics anyway. A clarification question on what you said from Kyung Alvarez. How do you define the distinction between financial risk and real risk? Can you just give us your definitions here?
So I knew I shouldn't speculate, but this is a good question. Look, I'm talking about traditional. Maybe this is too long back when banks lend to projects, real projects, and there was real investment which got kicked off because there was credit looking for a home and was funding that. That, to my mind, was the old style monetary easing, pushing real activity and creating jobs, etc. And I wonder, and this is more a question, whether what we're seeing is much more of a willingness to finance speculative activity, financial risk-taking, as opposed to the real risk-taking projects with an uncertain outcome, but which create real activity. That's just a question. As I told you, I don't have ready answers on that.
A question from Ted Truman, which is kind of very general on what all this is about. What is the case for shrinking central bank balance sheets? And he notes that we haven't talked at all about inflation yet, so probably now is the moment. And Ted says some would argue this is all about inflation.
Yeah, I mean, at some level, some version of the quantity theory would suggest that there is an inflationary implication there. Of course, as you know, the monetary theorists have moved away from that, but I would argue that certainly central banks feel that they cannot continue maintaining really large balance sheets and at the same time argue that they're tightening financing conditions and creating sort of monetary tightening, and therefore some shrinkage of the central bank balance sheet, and certainly not expansion, but even shrinkage may be necessary to reverse easy financing conditions. The other sort of argument, if you believe that QE works by and this is the point Megan made, there's a lot of controversy about how exactly it works, but if it works, and again, whether it's stock or flow, again, lots of controversy, but if it works by holding down long rates, then part of monetary tightening would be to reverse QE, in other words, QT, with the idea that you would allow long rates to find a higher level. And that would be part of monetary tightening. It's not just with the policy rate, but with the long rate. I think the point, again, Megan made, which is important, is that it's also about the political economy. I mean, this is a point that Charles Plosser has made, which is that, look, when you have large central bank balance sheets, basically the political establishment says, oh, you have no cost to maintaining those large balance sheets. Why don't you finance infrastructure? Or why don't you finance, my favorite little pet project? And having been at an emerging market, I know these kinds of claims come left, right, and center. Why don't you finance my favorite exporter? And it's very hard over time to continuously say no. And eventually, the parliamentarians say, well, we'll take it into our hands and set aside separate facilities to finance this and that and something else, which are our favorite hobby horses. So I do think there is a political dimension to the central bank balance sheet also, apart from any monetary implications it may have.
Megan?
Can I just add one quick thing? If the scenario is right, where we just have this constant ratchet effect and liquidity squeezes that central banks have to step in to fix, like the Bank of England did. We call what the Bank of England did QE, but there are a lot of different things that we call QE now. We've just thrown a bunch of different types of operations in that bucket, I think for simplicity of communication, but I also think central banks might come to regret that. So restoring market function is QE, so is maturity transformation, that's also considered QE. And so if central banks have to step in with what we all call QE, eventually, if this keeps happening, then investors are going to think, well, hang on, QE is actually inflationary. And so in the moment that we're in right now, where every major central bank is trying to lean against inflation, if they keep stepping in with QE and that's considered inflationary, that undermines most central banks' main goal at the moment. And so I do think that that could really make it more difficult for central banks to address inflation. They may end up having to tighten even further in order to bring it back into line with their targets.
Right. I mean, absolutely. And that was what the Bank of England had maybe at the back of its mind or the front of its mind when it said this is temporary, right? It was trying to say we're not going back into QE, because that sort of completely sends the wrong message about the monetary tightening that's happening with the interest rates. And so they pulled it off. It was temporary and it worked to alleviate market pressures. But of course, we also had a change in government soon after, which helped stabilize the pound and long-term interest rates.
Good. Truman pushes the argument, saying, well, if emphasis on if the liquidity squeeze down the road is a problem, then should we not do QE? Is QE the problem to start with?
I think this goes back to, again, Megan's point, Hotel California. You have to understand that permanent central... So nobody ever complains about temporary central bank intervention. That was their job, to provide liquidity at times of need, to liquefy assets with the what is used in final settlement, money or reserves, right? So nobody has a complaint with that. It's when you start a semi-permanent process of expansion and you say, oh, this will be around, then you're inviting everybody to act as if it will be around. And that makes it harder to withdraw because they've written claims on it. And so when you withdraw, it all backs up. So that, to my mind, is what we should explore more carefully about QE. That does it create this corresponding sort of belief in the private financial system that this liquidity will be semi-permanent. And, you remember there was a time when people thought QE infinity, it'll keep going on forever. And so when they think that, what do? And that's when we start talking about the distortion in the price of liquidity. They start writing claims as if this is never going to go away. And in fact, they ensure it never goes away. There's kind of collective moral hazard embedded in this.
So there are many questions from the audience. We probably won't have time to address them all, but they keep coming, and that's good. Let me ask two questions which are not directly mutually related on regulation. So Steve Cecchetti is asking about, a bit as Megan did, about the leverage ratio. He says all the liabilities attract an LCR.
Right.
Sorry, no, this is liquidity coverage ratio. I'm confusing my acronyms. So does the liquidity regulation play a role? Yeah. But you may also expand further on the leverage ratio. My apologies for confusion. And also we have an anonymous, I think, question about collateral rules. And, it was mentioned that a lot of what happened in the UK was margin calls. So when you look at the derivatives market regulation, do you think this had a structural impact in terms of the risks you described, and especially the mandate to have more collateralization?
I'm not sure I have a good answer to the second question. Let me try the liquidity coverage ratio. What we find is banks are moving in the opposite direction to what might be suggested if the liquidity coverage ratio was binding. Remember, the liquidity coverage ratio comes in and probably affects some of the larger banks, 50 billion in assets and above. And, you would expect such banks to prefer time deposits to demand deposits, because with time deposits, it gives you you don't have to maintain liquidity against those time deposits. Wholesale demand deposits, you do. But instead, banks during the period of QE are moving in exactly the opposite direction. And during QT, they don't reverse that process. So essentially, time deposits are coming down more and more as part of the system. And as I said, this is not just a time series effect. You can see it across banks. The banks that have more reserves during the period of QE are shrinking that time claim. So it doesn't seem as if the LCR is the binding constraint, because it would push them in the other direction. It would push them towards having more longer-term liabilities. And the question on derivatives, can you point me to that question so I can see?
It's the one by an anonymous. Okay. So I clicked it as answered in your.
There's a question on.
I can read it. We have not looked at how fully collateralized financial system post GFC has not hardwired liquidity stress into the system. Don't we need to look at underlying functioning of the repo market to solve liquidity transformation in the system? I maybe have extended it a bit too much to derivatives.
Yeah. I mean, clearly, any source of liquidity and who it goes to matters. And one of the questions about the central bank expansion, and then re-intervention, is really this question: who gets the liquidity in times of stress, and who is hurt at those times? I mean, again, big public policy issue with the problem with the UK pension funds. And so I do think that as we spend more time thinking about this, we will come to realize that there are some actors who benefit from the liquidity infusion that the central banks offer much more than others. So there is, we are picking winners and losers in this process, something that is another source of concern with the central banks being such big players. Let me just say one thing. Somebody asked about why I said the UK LDI event was a liquidity event. And the reason I say it is, look, the problem was, as I understand it, that the pension funds had taken on some hedges on interest rates. And with the large change in interest rates, there were margin calls on the pension funds. And therefore, in order to make up the cash on these margin calls, they started unloading some of their long-term assets, which then pushed up interest rates even higher. The classic problem, with these kinds of hedges. I think why I call it liquidity is the problem would have been solved if they could have gotten financing. Everybody knew that they were solvent because they had assets and liabilities were actually overall matched with these kinds of hedges. But the problem was that nobody was willing to lend to them to meet these margin calls. And that was why they had to unload assets. That was why there's a fire sale. So the real question is, why was nobody willing to lend to them? You could argue that it was the way it was structured. heard there was a lot of credit risk embedded, maybe. But the broader point is that there was a liquidity mismatch in the system, maybe because of structures, maybe because of something else. But an infusion of lending into the pension funds would have solved the problem without necessarily intervening directly, either in the market for reserves or in the long-term debt market.
And that was Miguel Civilioti's question. Megan?
Yeah, I just wanted to mention quickly that I think the UK scenario was fairly unique in that it was quite contained to the pension sector. There wasn't a solvency question. But Raghu, you remind me of a paper by Ramin Taloy on how QE works exactly, and his finding is that it's mainly through the announcement effect. And so if that's right, and we still don't really know, I don't think, but if that's right, then central banks, when there is a full-on meltdown like we had in 2020 or after the global financial crisis, if it's all in the shock and awe of their announcement, they can't also say, but we're not going to do this for that long. So please don't extend lines of credit, banks. So inherently, you can't have QE be effective if what you're trying to do is address the issue that you're bringing up, Raghu, which is that banks fundamentally change their behavior when there's QE. So it's a Gordian knot.
And Mervyn King is making, I think, a similar point. He's asking about an ex-ante framework for the provision of central bank liquidity. Do the panelists agree that without such an ex-ante framework, we are doomed to the ratchet effect that Megan mentioned?
Well, I mean, that's what we call liquidity dependence, right? Or alternatively, the Hotel California effect. You can get in, but it's very, very hard to get out. And maybe it's, as Megan said, it's the nature of QE. You're sort of promising you're in it for long. The announcement effect works if what you're saying is, while I'm doing QE, I'm not going to raise interest rates. And therefore, it's sort of, that was what Krishnamurti and Vissing Jorgensen thought was the biggest effect of QE. And so if you are doing that, it's sort of carte blanche for everybody else to say, oh, liquidity is going to be semi-permanent. Let's go splurge. And issue claims on it. And of course, if everyone issues claims, we know the central bank is forced to come in and intervene when liquidity dries up. It's collective moral hazard, and that's how this sort of gets sort of sustained.
We have two questions from Lazarite Mokhtar and Vishwanath Tirupatur on the international comparison. So one is about specifically the difference between US and EU in terms of liquidity risks. The other is more broadly about what's common and what's different across countries and regions. So of course, your presentation, Raghu, was about data in the US, but can you give us a sense of both the EU dimension and also a broader issue? I'm not going to ask you about the Adani fiasco, even so we have a question about that. But anything you want to say about this kind of cross-border comparison?
Well, let me be careful. We have not looked at the EU in detail. There are some reasons why I think it might be different. Just the way the ECB intervened in financial markets, including the fact that it was much more central in lending to the banks. So how that affects things, at least Sasha, who has a better understanding of the EU, says it might be different there. However, after our Jackson Hole presentation, our friend from Israel went and ran it in Israel and said, this is exactly what's happening in Israel also. So I think rather than saying this is a general thing, I think we need to look at it more widely and see what's going on elsewhere. I do think that it's the underlying theoretical ideas. Viral and I wrote a theory paper before we actually went to look at the data, and we were amazed that the data was at least moderately supportive of the theory. So the idea really is, when you have these very low yielding assets on your balance sheet as a commercial bank, right? Your reserves pay very little, but you're forced to hold it because commercial banks are the repository of reserves when the central bank largely expands its balance sheet. Then you write claims on it. You would tend to finance it at the lowest cost, which is demandable claims, but you would also write other claims on it because it's spare liquidity sitting on your balance sheet. Hey, who wants backup funding? Who wants lines of credit? Let's get as much as we can in fees on it. And so it's really a very natural reaction from the commercial banks to do something like this, and therefore I don't think we should be surprised that it's there in other situations also. What we find less easy to understand is why it doesn't reverse that easily when you do QT. And part of the story may be I've written a line of credit to this company, and just because the central bank is reducing liquidity, I can't suddenly go to my relationship company and say, hey, I changed my mind. I'm not going to write this line of credit because the line of credit is backing up so much else. The leverage loans, et cetera, that they've taken on is backed up by a line of credit. So in that sense, I think there may be ratchet effects which are genuine, and it's very hard to reverse it. I think that one other question that somebody had, which I think is important, is I think it was Steve Cecchetti on the reverse repo facility, and that's I think a new development since we did our study, because the reverse repo facilities really started taking off in 2021, and essentially what they're saying is there's so much liquidity in the system that banks aren't taking anymore, and it's flowing into the money market funds, which are essentially putting it back into the Federal Reserve. So I think with the reverse repo facility, there's a little bit of cushion, whereby by reducing reserves in the system, what you first affect is the reverse repo facility, and eventually you start eating into the reserves in the commercial bank system. But I would just note that there was an article, I think it was in the FT a few days ago, which basically said there are a lot of small banks now which are desperately borrowing reserves in the interbank market. And that is suggesting that a bunch of banks already are finding a little bit of tightness and being more dependent on the interbank market for reserves. Now, I don't think it's anything near crisis at this point, but it's worth monitoring this as you remove reserves from the system. I do think till the reverse repo facility sort of shrinks considerably, maybe there is still some room in the system for shrinking reserves.
Megan, you spend a lot of your time looking at the EU. So how do you feel about the read across there and possibly to other jurisdictions?
Yeah, so I would need to look at the data to know for sure. I think the banking sector is a much bigger feature in the Eurozone than it is in the US, just given our capital markets are much more developed. So I, like Raghu, would expect it might operate a little bit differently, but I would need to look at the data.
There's also one of the participants asking again your question about non-banks. Maybe Raghu, you want to comment on that?
This is about the access to the repo facility, standing repo.
Yeah, exactly.
So I think in principle, I don't see why any reasonable institution, which has eligible securities, should not be able to go and repo it with the central bank. I understand there are some concerns about credit quality and so on, but these are, repo transactions. And so to that extent, there's collateral backing them. So I do think that, if you have these facilities, extending them as much as possible is important. I do, there is a larger question of how big central bank balance sheet should get without any control. Can everybody sort of put back to the central bank and borrow reserves at a moment's notice? And that is a harder question to understand. Essentially, what you're saying is emergency liquidity is not emergency. It's liquidity available to anyone against eligible assets. And certainly the banks have that ability, but some of it may be constrained by fears of using it too much. And I don't know if what sort of new concerns are raised when you open it up more widely. But it seems to me that you should eliminate rents in this process because you're providing a public service.
Yeah, I think this is a politically charged issue for the Fed. Certainly, they don't really want to be backstopping the non-bank sector, which may be where all of these liquidity problems lie at the end of the day. I agree, you should be able to handle it by demanding high quality collateral. But I do think it's more of a political issue than a financial one for the Fed.
And we also have Andres Portilla opining on this, on whether a lot of risk is being squeezed out of the banking sector, and so traditional channels of liquidity work less effectively. So he's asking more about regulation of the non-bank sector, which echoes your point, Megan. Yeah. A question from Piros Kanagi on the reactions of banks. What's behind banks not increasing interest rates on time deposits? Is it to increase profitability? Is it just free availability of central bank liquidity? Anything else? What do you think?
Well, I think it's again a natural reaction, right? If demand deposits are cheaper than time deposits, because with time deposits I'm paying for the time and for protection against it being demanded on short notice. If demand deposits are cheaper and I've got plenty of liquidity sitting on the asset side of my balance sheet, then I'm naturally going to move from time deposits to demand deposits. That's what we're saying, that you're almost forcing the system to go short rather than encouraging it to go long. And this is essentially offsetting the sense that, oh, you just bought long-term treasuries from the system, and therefore it will look to replace those long-term treasuries with other long-term assets. And in the best of all worlds, it replaces them with long-term projects. So you get a lot of wonderful activity. Well, that's not happening. And part of the reason is even at first stop, the banks themselves are reversing this by issuing shorter-term claims. So that's the sense in which it doesn't work, at least in the portfolio balance approach that was the original sort of thinking behind QE, doesn't work as advertised.
Maybe a final one. I don't know if it's ending on a light note. Chris Anstey is asking about perspectives on liquidity risk posed as a U.S. payment default if Congress doesn't pass the debt ceiling. Any comment on that forthcoming episode?
Well, I really hope it doesn't happen. I think we have, look, it's one of those, it's like Y2K. You have no idea what will happen if it, if there is a default and what else gets triggered. So I hope we don't go there. I really hope we don't go there.
Yeah.
Megan, you get the last word.
Sure. I actually wrote a column on this yesterday, and it went online yesterday in the FT and today in the paper. But, I had been arguing that the good news is that the Fed has a lot of tools that it can use. Now, Raghu, you're making me think that might not be such a good thing because there might be a ratchet effect. But there is a lot that the Fed can do through repo facilities, reverse repos, but also in extremis, the Fed could accept defaulted treasuries as collateral or could buy up defaulted treasuries. That's not technically illegal, though. On a 2013 FOMC conference call, Jay Powell called those options loathsome. So that gives you a sense of their appetite for it. But if we were to get a default with all kinds of knock-on effects in terms of liquidity, the Fed could step in a la Bank of England last fall.
Let's hope we don't get the answer to that question because it doesn't get tested. Thank you so much for a very enlightening conversation. I always, I think I'm not alone. I always struggle with these liquidity issues. So this was very thought-provoking. Many thanks to Raghu Rajan and Megan Greene. The next session will be on February 22, a little bit later than usual, because we'll go to the US West Coast. We'll have a discussion with Curtis Milhaupt and Chanlei Huang at the Peterson Institute on corporate governance in China. Many thanks for attending this session, and have a great rest of your day.
Thank you.
Thank you.
Thank you.